To start with, no. I'm certainly not confident that there's no risk in these banks. I think that they are very risky. They are certainly not compliant with Basel II, and also they're not reporting according to international financial reporting standards. But I think that these aren't really the main issues with the banks. I believe that the Iraqi accounting system, although the manner of presentation of the accounts differs somewhat from international reporting, that the bottom line is essentially the same. The presentation format is different, but the accounting standards that they're applying, in other words, questions like what counts as revenue and what counts as an expense and so on, or how do we depreciate assets, I think that these are all generally compliant with international financial standards, though there are exceptions. For example, Iraqi companies are not, I understand that by law they are supposed to be consolidating subsidiaries, but that they routinely don't do so. So there are exceptions like that. But I think that these aren't the real problems. The real problem, I think, yes, I guess I got sidetracked. But the real issue with the banks is not how they're presenting, but what they're really doing. And I think a lot of what they're really doing is involves related party transactions, that the majority shareholder family is using the bank funds for projects of its own. And an interesting example of that is majority shareholders apparently will get a line of credit from their own bank to take up the rights on, when their bank has a rights issue, they'll take up the rights on the shares that they're holding by borrowing the money from their own bank to take up their own rights. So that means that the capital base of the banks is not quite perhaps what it seems, because if those majority shareholders don't pay back those loans that they've taken out, that capital disappears because that loan gets written off, and that's going to be a charge to the bank's capital. So that capital, as long as everything's going fine for the majority shareholder family, that's capital is real capital, I suppose, but it's very contingent upon this guy being able to pay this loan back. It's a bit like the situation with the Japanese banks, I think, that, I mean, certainly it's a thing that we find all over the world, is that somehow bank loans are being turned into bank capital, that it's not unique to Iraq. But I mean, this is the type of problem. It's not a problem with the accounting standards. It's a problem of, really, I think the number one problem is related party transactions. However, though, I think that related party transactions sometimes make sense in a way, because the related parties at least know what they're doing, that they have control over that investment in a way that if they lend it to someone they don't know, they have less control and maybe more difficulty, less in the way of legal remedies if the loan isn't repaid. So people have made a case for this type of arrangement where the bank's shareholders are using the bank's funds to finance investments, simply because it's a control problem. But I think that really it'd be fanciful to say that wasn't a risk. I think that's the number one risk that I'm aware of, yeah.